Well, as you get your trades ready for tomorrow's tuggin', listen to these phrases directly from the Federal Reserve, and I will put them on screen. On balance, and despite the suggestion about feeling strongly that we should be easing economic policy, strong inflationary pressures still persist. If we were to attempt to ease, it's pretty clear that everybody would think we had let the inflationary cat out of the bag, and it seems to me that interest rates would be even higher under those circumstances. So, I don't think we have a choice. We have to stay on our general path here, but the scenarios of what could possibly happen can be pretty wild. Chairman Volcker, I'm not quite sure where that leaves us. Response, scared. Yeah, that is from 1981, March 1981, when the yield curve was just as inverted as it is today, about negative 40 basis points. And today, we're in a market where, let's just say, stock market concentration is sitting at levels that we haven't seen since the Great Depression, which should be concerning. Now, does that mean it's time to cut and run and go bearish on everything? Maybe not. Maybe things just aren't that bad. Maybe the economy is just growing well and interest rate sensitives are going to get hurt for a little while longer. But there is a growing concern amongst banks on Wall Street that maybe we won't get as stable of an FOMC dot plot tomorrow. Now, Bank of America still thinks so, and Bloomberg Intelligence, they still think we're going to get 3 rate cuts in tomorrow's projection. But what I'd like to show you is the following. Well, keep in mind, I've posted all of this on ehack.com. I want you to see what Goldman is warning. These right here are the dots, the infamous dots. And what these dots say is, well, they basically just chart where the FOMC's projections are as of December. Notice how most of them over the long term settle down over here at 2.5%. That's where the long-term Fed policy rate is expected to go. There is, however, some concern right here by Goldman Sachs that we think the risks are now higher than they have been about repricing higher dated rates. And the median dots could show fewer cuts, or if they do, rather, we think that longer run will start to drift up. So let me explain that in English. Basically, these little yellow dots might move up. And if these yellow dots move up, then the entire curve becomes a lot more flat. Now, in English, what does that mean? It means the markets are not pricing in the risk that you could see 10 or 20-year Treasury yields go up even higher than where they sit now. Consider for a moment, we ended the year with about a 3.8 10-year Treasury yield. Now we're sitting at about 4.3. This evidence, or sort of this, maybe, I guess I shouldn't call it evidence, I should call it more of a belief or concern, is why you have some folks arguing that 10-year could either stay here at 4.3 or sneak its way up to 4.5 or towards that 5% direction before. We've got major resistance at 5%, so I don't think we'll Bill Ackman break through that. But this potential for sticking in this mid-4 range puts massive downward pressure for longer, the boot on the neck, so to speak, of the interest rate sensitive stocks, and specifically creates a risk that what if markets aren't as attuned as they need to be for the fact that the Fed could slowly start tugging us tomorrow. Again, Bank of America made it very clear that Bank of America thinks the Federal Reserve is going to keep the summary of economic projections mostly in line. This is an eHack that we have broken down on it, and here you can see Bank of America's global research forecast. At the bottom, you can see they actually think the FOMC's Fed projections for 2024 will stay at 3 cuts. They don't even move it at all. They keep it at 4.6, just like in December. Now, I personally think this is mistaken. I personally think we're going to see a move here to 4.8, and we're going to see a move over here to over 4%. Now, keep in mind, you can see Bank of America does adjust that 2025 target up. So you're really only setting up for maybe 2.5-ish cuts in 2025, but they're keeping that longer run, 2.9 and 2.25, which is behind my face there. There you go. So is it entirely possible that even Bank of America is noticing there's a risk that those longer term yields could start rising? Yes. Now, why would that be? Well, we've broken this down before. Scroll all the way to the top of eHack where we post our research totally for free. eHack.com, what do we have here? We've analyzed this before. The potential fear that persistent wage levels, elevated wage levels, and this sort of stagnating of declining wage growth could end up hurting the Federal Reserve's desire to cut. Much like what we saw in 81, the Federal Reserve might be of the mindset that, if we send any signal that we're done, then markets might psychologically break, thinking, oh my gosh, the Fed has let the cat out of the bag and they're not finishing the job. So the Federal Reserve has to be careful here not to signal that they're done with their job and that they're actually trying to get more bullish on the economy and more dovish, therefore. Instead, the Fed's probably in a position where they don't want to give us a full rug pull. We don't want to bring out the black swan, but we got to tug. We got to tug a little bit, tug at that rug a little bit and go, hey, we got some more work to do here. So that's why I think when we combine this with average hourly earnings stagnating around the 4% level, the decline here in wage growth is slowing. Remember, the Fed target for wage growth is 3%. We're just about 4% right now. JOLTS stagnating around 20% higher than expected, or where we were rather. And keep this in mind, structural inflation concerns in that, you know how China helped us with deflation? Back in the 1980s, we imported just 2% of our stuff from China. By 2017, we were at 22%. Well, over that roughly 40-year period, we had some nice disinflation. Okay, great. We like disinflation. But what's happening? Are we importing more from China? No, we're actually importing less. And because we're importing less, now just 14% in 2023, we benefit from China's disinflation less than we might otherwise. And so I think when we put together not just the black swan risks of junk bond bankruptcies and some of the other like the 80% increase that we've seen in bankruptcies or potentially a labor market recession, some of these other black market black swan risks, we do want to evaluate the case for these dots moving up significantly tomorrow, at least more so than markets expect. I think there's a chance the Federal Reserve gives us that little tuggins, and it's just phase one. And I think that case is more likely than not. Now, what we want to make sure we're very, very clear about is that on Friday, we're going to be raising the course prices for the Stocks and Psychology of Money group and the other courses at meetkevin.com. This morning, we went into the market with a triple short, all three of them profitable, which is great. So if you want to see all the buy-sell alerts, everything that's going on, all the trades we've been doing the last week, they've all been profitable. I've got one going right now as well. And if you want to see all of the alerts, make sure you check those out. Go to meetkevin.com, Stocks and Psychology Money Group. At the very least, you'll get lifetime access to the course member live streams. We're not charging for those ever. Once you're in, you get lifetime access forever. So if I do course member live streams in 20 years, you pay once today, you're still in. It's kind of cool. And I've been doing these course member live streams since like 2018. So we're 6 years strong in course member live streams. People who bought back then got a sweet, sweet deal. If you want to bundle up, just email me at staff@meetkevin.com. We'll take care of you if you're already a course member. Or if you want to bundle it with coming to our event in June, email us, staff@meetkevin.com. We'll take great care of you. But what I really want to highlight is something that I think a lot of us don't want to hear. And it's something we briefly touched on this morning in our course member live stream. I don't like doing this. But here we go. You have to consider that right now, the FOMC, and again, this is very, very clear from the FOMC, 2024 rate cuts, 4.6%. This is based on December, right? 2025, there we go. We are looking at a forecast of 3.6. Those are the December numbers. 2026, we're looking at 2.9%. Something that markets are not paying attention to is not whether or not we get 2 to 3 rate cuts in 2024 or when it starts. That part's pretty clear. We're pretty well aware of that. We've got basically a market implied 0% chance on the Fed rate monitor of a rate cut tomorrow. So, we're less than 24 hours away from that. 0% chance of that. Less than 3% chance we get a rate cut in May. We're at about a 37% chance that we don't get a rate cut in June. So the market's still pricing in June. I think July is really the earliest, but that's okay. We've already talked about that before. What matters more is what the Federal Reserve says about this. The economy continues to surprise to the upside. And don't get me wrong, the 10-2 yield curve, or the 2s, 10s we like to call it, is telling us, hey, we're as inverted at negative 40 basis points as we have been since 1981. That's a problem. There have been other little periods where we've briefly touched, but we were coming out of a hole on inversion, negative 100 basis points inverted. Now we're at negative 40, which is very similar to what we saw in 81 before the Fed decided to raise rates another 5%. From 14.5 to like 19.5. Now, don't get me wrong. I'm not saying the Fed is here tomorrow to try to raise rates, but I do think the Fed is going to look at history and some of those comments that we saw in those notes I showed you at the beginning of this video about them being scared and about the psychological move of their impact. I think the Federal Reserve has to forecast very, very clearly that the job ain't done. So how do you do that? Okay, let's go in here. So we're going to write down how to forecast job not done yet. Okay? Progress being made, but we want to forecast job not done yet. Well, if you're working at the Federal Reserve, what would you do? But the tug you start doing for implying the long term, the job is not done, is right here, folks. The 2025, 2026 numbers are going to be everything. And based on what I'm looking at in the minutes from the 80s, if the Fed is at all inspired by Volcker, which I think they are, I think they realize they cannot signal the job is done. I think there's virtually zero chance, less than 5% chance, that we're going to see these numbers go down. Maybe I'm wrong, but I actually think it's much more likely they go up, and substantially. 3.9 is what Bank of America thinks. I think 3.9 to 4.1 right around here. And honestly, that 2.9, it's got to become a 3 handle. That's how you tug this market. It's going to come tomorrow, in my opinion. Now, one of the things I'm watching right now is the Qs broke over our open level. After we broke our open level, which is this lower yellow line, we had a pretty rapid move up to about 438.98. That's roughly where we sit at the time of this recording. We've been rejected once, twice, 3 times. We've been rejected multiple times. This is the 1, I understand. The 1 is not so great. But look at the 5-minute. We're getting rejected here. We could break out into the close. If funds start buying, we break out into the close. Oh well, too bad, too sad. I guess this ends up rallying into JPOW day. That is possible. But I think there's a chance the market, if it rallies into the close, is totally missing the boat on what JPOW is going to deliver tomorrow. I don't know. I could be wrong, but I think they're making a little oopsie-doopsies. What's better is being cautious going into tomorrow. We shall see. That's my take. Let me know what you think in the comments down below, and I'll be covering JPOW live tomorrow.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.